on the more horizontal issues in DG Markt, and we're very happy that he could make it in the end because there were some short-term problems in DG Markt over the last 2 days, for those who know. Then there is Guido Bicisau from the EIB, European Investment Bank, very strong partner in the whole debate about long-term investment, project finance, but also in the area of SME financing. Guido can explain this in a moment. And then we have Ian Bell from the Prime Collateralized Securities Secretariat, a new organization which has been created, but he can explain this in a moment, what they are doing and how what their view is on that, and how they, what approach they have to solve these problems in securitization markets. So I start with Miguel. I think each of you will speak for about 10-15 minutes, and then we'll have a debate. We have announced this that would last until 3 o'clock. I think it may be rather 2:30, 2:45, but anyway, it depends upon you. We shouldn't have too long presentation, but above all, also a good debate. But I think we have 3 excellent speakers which will give you a different perspective on that issue. And then after that, we can have a questions and answer session with the audience. So thank you, Miguel.
Thank you very much, Carol. It's a pleasure to be here indeed. As Carol mentioned, tomorrow we are publishing, the Mark is publishing the green paper on long-term finance. Essentially, it's a document, if most of you have probably seen green papers before, which raises issues and asks questions. So, as it were, part of my goal today is to advertise that the paper is out there as of tomorrow, and hope that you will read it and that you will respond to many of the questions that arise there, in particular those that relate to the topic of today, securitization. And to provide a background for that and to give you a sense of the type of work that has been undertaken within the Commission and in particular within DG Markt to understand these markets and where we are today and how we could essentially promote them further. I will focus today on essentially two parts. First, to give an overview of what the situation is as regards securitization across Europe. And secondly, I'll sort of identify some of the problems that were probably related to its very sharp decline after the financial crisis struck, and that are presenting a challenge for us, of course, in reviving securitization within Europe, certainly. So let's first look at the evolution of securitization issuance globally from 1996 to 2012. The securitization issuance for asset-backed securities and mortgage-backed securities experienced indeed, as you can see from the graph, a sustained increase from 96 until 2006, right at the eve of the crisis. And this was coinciding with a cycle of economic expansion, large demand for credit, and very, very gentle and significant liquidity. This trend was reversed as of 2007, and that was coinciding again with the start of the subprime crisis, and there was a significant decrease in issuance. It's interesting to point out here that issuance of corporate bonds has actually shown a trend opposite to the issuance of other instruments that are shown here in this figure. Whilst their issuance did not experience a large increase in the pre-crisis years, it has experienced a sustained increase over sort of the aftermath of the financial crisis. So let's look at figure 2. By the way, all of these figures are public. Probably many of you have seen them already. They come from different sources, and they are all included together in an internal paper drafted by one of my colleagues, who I was thanking on the first slide. This is the figure representing the European yearly issuance by country, and what you can see here is essentially that the trend within Europe was following the global trend, increasing up to 2007. One extra 2008 was a sharp and then very sharp decrease after that period. And the United Kingdom, Germany, France, Spain, Italy, and the Netherlands are the main countries where securitized products are being issued or have been issued.
The important thing there is that the market is still even below the 2002 level, and if you compare with the previous slide, we are further down, let's say, than the global market is.
Yes. Now, what happened? Why this sharp decline took place? I think on hindsight, the review of the events leading up to the crisis and then this very sharp decline observed in securitization suggests that there's been three problems, probably of a structural nature. First of all, there's been misalignment of incentives that led originators to focus on volume and short-term profitability, and thus in turn to take more risks. For example, the evolution of the originate to distribute model, which you're obviously all familiar with, encouraged banks to securitize more poorly underwritten loans. And the fact that securitization process induced the transfer of credit risk to investors, as well as the possibility for banks to shift the risk outside their balance sheet to the markets, also gave fewer incentives for originators to monitor the quality of the underlying assets. So that's the first problem, misalignment of incentives. Secondly, there was a lack of transparency. The involvement of a large number of parties in transactions led to increasingly very complex and very opaque securitization structures. As a result of this, as you could imagine, investors had limited information about the risk and the performance of the underlying assets, and they were not fully aware of the nature of the risk they were in fact taking when purchasing the securitized products. And finally, and very much related to this, you have the complexity and limited transparency that's leading to a over-reliance on ratings. And as a result of all this misalignment, securitized products became increasingly complex, increasingly risky, and investors were not really informed about the risks. This perception, these products remain remain having these structural flaws, as it were, is still out there, still in the market, and is not particularly easy to attract either originators or, for that matter, interested investors. Here's reflection of some of these problems in action. This is showing the drying up, how the drying up of the subprime mortgage-backed securities in 2007 led to a collapse in global securitized markets, as investors indeed lost confidence in the quality of the securitized products for the reasons mentioned just before. So this situation has led to a decline in primary issuance, as well as a lack of liquidity in secondary markets. So let's look first at the decline in the in primary issuance. So on the primary market, issuance has decreased, but has continued to some extent. That's I guess the silver lining. But it went from 450 billion in 2006 to 80 to 90 billion in 2012. That's in the EU. That's a black bar on the right-hand side of the left-hand side. The one until 2010 on the left-hand side graph. Within the placed issuance, the CDOs, collateralized debt obligations, and the CMBS, the commercial mortgage-backed securities, have suffered the most from 2008 onwards, as you can see on the right-hand graph. And it's worth pointing out here that in Europe, in fact, securitized products are mainly used as collateral for the ECB credit operations. As a consequence, the majority of securitized products in Europe is in fact retained rather than placed. That's up to 76% of 2011 overall securitization issuance was in fact retained by banks. So this reflects, again, this strong risk aversion of investors. There's a bit of timid recovery in 2011, in 2010, but it's not yet, I think, sufficient for us to be quite optimistic. So let me just, it's not working anymore.
I know it's there.
Oh, okay. So what about the SME loan securitization markets? Well, this followed, unfortunately, a quite similar trend, and they also experienced a sharp decrease. In 2010, the issuance of SME loan securitization accounted for about 10% of the overall securitization market, which corresponds to the average observed in the last decade. But the majority of these products were also retained as collateral from the ECB. So not much of this is really yet being channeled into financing the real economy of the SMEs. Again, this doesn't, there's, I guess, a delay or something. More. Okay. So what about outstanding securitized products? Well, it remains high, and that's for obvious reasons. Securitization issuance is what peaking just before the financial crisis. But by the end of 2011, more than half, so that's 51% of the 2.1 trillion in outstanding European securitization was estimated again to have been retained by banks, reflecting the funding difficulties and the role that the ECB is providing in terms of providing liquidity to the euro area banking system. By contrast, total securitization outstanding in the US market is 4 times that large. The graph should have been made proportional, but basically it's 8.2 trillion in equivalent terms. And demonstrating essentially, we'll see in the next slide, a bit later, that the securitization markets in the US are much highly more developed, of course, than they are in Europe. Still at the moment, and probably for years to come, unless something's done about it, which we'll come to in a moment. So this is again showing that essentially most of it is being retained rather than placed. What about the spreads? This is quite interesting. I mean, regarding secondary markets, European sovereign risks, in fact, appear to be impacting securitized product yields in some of these markets, in particular core markets like Spain. The spreads of securitized products are varying considerably across asset classes, and while some products such as CMBSs remain high-risk assets, spreads for asset classes such as RMBSs or card and auto asset-backed securities have decreased significantly, and a surge of rating downgrades has also impacted the spreads. However, as one can see from the figure, during the period of market turbulence, that is in 2011, of greatest market turbulence indeed, the market price performance of European RMBS was superior to most EU sovereign debt and senior bank debt and many covered bonds, except for the fund Briefe. Oh, sorry, that was... Right. And final point, collateral performance has remained strong in the past few years, despite the crisis. From mid-2007 to the end of 2010, only 0.95%, that's a little bit less than 1%, of all European structured finance issues defaulted, compared to 7.7% in the US and 6.3% among the universe of global corporate bonds. So, I mean, these are relatively safe products, after all. Now, what about its prospects as a tool for enhanced financial intermediation? So this is the key question that can be posed in this context, whether securitization can contribute efficiently to filling the gap between commercial borrowers and institutional investors. Well, there's estimates suggest there's a global funding gap for non-financial companies around 43 to 46 trillion globally between 2016 and 2012 and 2016. Of which Europe accounts for approximately 1/4. That's $11.4 trillion. And this includes 30 trillion of debt to be refinanced and 13 trillion to 16 trillion of new money that's needed to drive new growth. So that's the challenge.
Sorry, what was the sum you mentioned? How much trillions for new growth?
For new growth, 16 trillion.
16, yeah.
It's a bit daunting, isn't it?
No, I thought almost 60.
No, 16. Still daunting, though, yeah. I'm afraid. Now, this, of course, is this need for new growth. This is taking place in a context where we're observing, or at least we should be observing, a trend towards bank deleveraging, a significant trend in Europe, and it's not as deep as we thought it would be by now, but it's obviously taken place. And indeed, in 2012, the level of bank assets in the Eurozone will fall by approximately 4.9%, and that is approximately 1.6 trillion compared to 2011 levels. And in fact, global corporate loans are expected to contract as well by 4.7%, that's 224 billion, and are not expected to surpass their pre-crisis peak of 4.8 trillion until 2015. And here we come back to the slide that you're probably all more than aware of, and this is that within Europe, at least, we don't have well-developed capital markets, not at least relative to the US. And this is, I think, the challenge that we have to face. So how we can do this? How can we introduce measures that would enhance the recovery of securitization markets? Well, I think here, first of all, there's a positive message of optimism and hope. Regulatory measures can influence the development of these markets, and I think many of them have already been implemented or under discussion. And so we should, at least we hope, in the very near future, observe a revival of these markets. And the measures, I think, fall into three categories. First of all, risk retention, many of which have been implemented. So this means that originating banks would be enticed to properly monitor quality of credit and credit risk of underlying assets. The CRD2 regulation, which entered into force already in 2010, December 2010, introduced a minimum risk retention rate of 5% of the total issuance of securitization products. The Basel III framework will induce an increase in capital requirements for re-securitizations, which is likely to encourage simple structures, all the more so as some complex structures have already spontaneously disappeared from the markets. This framework will also address the lack of due diligence, as it requires banks to meet specific operational criteria in order to conduct due diligence for securitization. So essentially, this is trying to send a very strong message out there of confidence on these markets. Secondly, we have the problem of transparency, how to enhance transparency. Here, public authorities have managed to do this to a large extent in order to rebuild investor confidence by reducing the reliance on credit rating agencies on the one hand. And also the ECB has launched in November 2012 the ABS loan level initiative, which implements new disclosure requirements in the eligibility criteria of ABS within its collateral framework. And on top of that, we have MiFID II, which is coming soon, we hope, which will require pre- and post-trade transparency measures for securitized products within the EU as well. And then finally, the already mentioned new regulations on credit rating agencies that have been implemented recently, and these reforms are particularly important for smaller investors, which do not have enough analytical capacity to assess credit risks of securitized products, even some of the most standard ones. Having said all that, that's the good news, but I guess the bad news or the potential constraints and barriers that we faced are still there in the short run. And this is because some of these barriers listed here are hindering both a strong recovery of the markets in the short term by affecting the demand as well as the supply. So the return of investor demand is hindered by two main factors. First of all, the negative perception of securitization due to the financial crisis, that the point mentioned earlier, but also the uncertain economic environment in which we unfortunately currently still are. And on top of this, relative pricing of securitization is not competitive enough, at least for now, to entice investors. On the other hand, on the supply side, uncertainty about the impact of regulatory reforms hinders the issuance of securitized products. And that's something, of course, at DG Markt we need to take at heart. For instance, the so-mentioned risk retention rule that we included in CRD2, or the fact that asset-based securities are not included in the Basel III liquidity ratios, are hurdles to securitized products issues. So this is the, as it were, flip side of the benefits that we hope to obtain through CRD2 and later from CRD3. So new capital requirements included in the Basel III framework will also make issuance of securitized products more costly. Now, and concerning more concretely SME loan securitization, the rebound of the market is particularly hindered as the credit worthiness of securitized SME loans is more complex to assess than that for MBS. The assessment of SME's profitability is more difficult and is also more uncertain. So consequently, this type of securitization requires a costly due diligence compared to the size of the loan that can deter banks to originate such products, especially in the current context of risk aversion. In this connection, I'll point out we at DG Markt are going to soon be publishing a paper called FCIR, which many of you may be familiar with, an annual report on financial stability. And very often every year there's some special features in there. One of the special features this year is on credit scoring, and essentially how the credit scoring industry can be further enhanced and fostered in tandem in order to facilitate this process of assessing the credit worthiness of SMEs. We hope that will contribute as well and feed into this beneficially into the securitization market. That's a survey, by the way, that we've done internally, so we're not relying on second-hand sources for that. And then finally, and with this I'll conclude, the real additional problem that we're facing today of the competition from covered bonds as a funding tool that is really hindering quite significantly, in my opinion at least, the recovery of securitization, besides the asset encumbrance problems that collateral, that the covered bonds generate, they can entice investors as they can provide them with these 2 layers of protection that everyone's familiar with, and then they benefit from a specific regulatory framework in most EU countries, even if it's not harmonized at the moment. And the assets supporting covered bonds remain on the originator balance sheet, and as a result of this, there has been really an increase in covered bonds issuance in these times of uncertainty and lack of confidence, as this type of asset suffers less from all the negative perceptions. But in fact, it appears that the silver lining here is that investors may actually value the diversification benefits of having both covered bonds and securitization markets. So, we should probably watch that space, and rather than see these 2 instruments as complete substitutes or partial substitutes, maybe they could be considered complements in the near future. So I think with that I'll conclude. The rest that I had planned, maybe I can share with you in the context of the discussion later. I don't want to overstep my time. Thank you very much for your attention.
Okay, thank you, Miguel, for a very interesting overview, interesting data, which also surprised me. Again, of course, we know, let's say, there's difference, but the difference with the United States is that high. I didn't remember. But also what you said at the end, let's say the value of diversification should come back again, but the market mood is still not up to that, and that is the question. Say some things have changed over the last 6 to 8 months already, and kind of this panic which was there, but there is still much more to be done if you want to go back to what we were used to. We move to Guido from the European Investment Bank. Guido, who's Director of Institutional Strategy Department, but also has been in different other positions in the European Investment Bank before, dealing with certainly long-term products for the EIB, and sometimes the EIB has forgotten how big a player they are on that market. So, Guido?
Thank you very much. What I wanted to do here is to set the scene from a wider perspective. So we have talked about securitization market during the last years, and I think that would be interesting today is to try to look at it from a side perspective as part of the core trend of in Europe. And in fact, following the financial crisis, the key factor that has occupied all policymakers is how to revitalize growth in Europe. And this is exactly where I would like to relate the 2 worlds as soon as we have. Thank you. So, what's happening in the wider context of European growth? As we all know, there is a very wide debate on the definition of the next budget exercise for the Commission, the multi-annual financial framework for the period 2014-2020. Where around 1 trillion euro are going to be in a way or another allocated to growth. Of course, the 1 trillion we know is not a definitive figure. In fact, has been lowered by the Council. The Parliament would like to increase. I mean, we know the debate, but the message here is that there is a lot of money that the Commission, the policymakers are trying to earmark for growth. There are many headings. The numbers I mentioned are not the definitive numbers, because, as I said, is part of the discussions underway between the Council and the European Parliament. However, we have main headings in research and innovation, cohesion, connecting Europe, agriculture policy, human capital, migration, external lending. So it covers a wide spectrum of activities across the European economy. In the interesting part where the whole discussion ties to securitization is that for the first time in a systematic way, the multi-annual financial framework talks about financial instruments. So there is a trend to move out of grants into financial instruments. Grants are money that is allocated and for which there is no return. Somehow is money that is allocated and there is no consequence. I mean, there is good consequences, we hope, but there is no direct connection between that money and additional activities generated by it. Financial instruments are a much more elaborated concept, and in fact represents a way through which the European Commission could generate a certain level of leverage in mobilizing private and public money from different entities to generate what everybody has listened to, which is the catalytic effect. So a way to energize the available resource in Europe. And in fact, financial instruments are nothing else but structured finance. So we are talking about securitization. In fact, there is somehow a risk component which is taken by the Commission and other players as EIB group. And then the less risky tranches are then placed into the market, trying to therefore attract investors' appetite for activities that are related to the main headings we have there. So everything related to economic growth. Which role for the European Investment Bank? As you all know, the European Investment Bank is the bank of the Union, is the bank which is supporting the European Commission and the European Union in achieving their main goals. The bank has been reinforced with a capital increase of 10 billion. And against this capital increase, the bank has been mandated to make an additional effort in its capability to finance growth in Europe. We have called this as the Growth Action Facility, which means that the bank would have to has increased the lending targets by 20 billion a year for the next 3 years. To give you an idea, the bank last year disbursed in excess of 50 billion, so 20 billion more is a significant increase of the efforts. In doing this, the bank has been, say, pioneering the use of financial instruments, and I mentioned too, the acronym are a bit obscure, but RSFF and LGTT are two different instruments the bank has used with the private market, with the cooperation of the European Commission is a co-sharing activity through which the bank is, in the first case, RSSF is supporting research and development in Europe, and the LGTT is related to infrastructure, so how ways to facilitate the generation of infrastructure in Europe. As probably everybody has heard, during the last year or two, there has been a strong interest to the PBI, the Project Bond Initiative, which is another financial instrument through which the policymakers and the EIB are trying to facilitate the development of infrastructure in Europe, considering infrastructure as the fundamental step needed to facilitate future growth in Europe. The overall is again linking to what I said before. The overall scene is we need to reinforce growth in Europe. The way to reinforce growth in Europe is to use the available resources to make sure that these resources are more effective than in the past. Therefore, we use the financial markets in order to generate a catalytic effect to associate with public money also private money. What is the role of securitization in all this? Well, as I said, the financial instruments that I mentioned before are nothing else but structured finance products. And securitization, the main purpose of securitization is nothing else but to facilitate the distribution of credit risk across the economy. I mean, we had the discussion about the change in the business model of banks. They originate to distribute. There is a reinforcement in regulation for capital requirements. All is going into the direction that is not possible for one single entity to capture the whole risk of the economic growth in a country or in the euro area. So what is important is to have an instrument which facilitates the tranching of the risk and the distribution of the risk to the appropriate investors. And not all investors are suitable to take all types of risks. So certain investors should be specialized in certain types of risks, either because they have the capabilities in terms of analyzing the risk, or because they have the strength to absorb such risks. Securitization is the only instrument we know about which allows this to happen in a very, very structured way. So of course there is different credit risk according to the different borrowers we can choose of, but the difference here is that we is not at a borrower level that you tranche the risk, but is a much more aggregated level, and that again relates much more to the link of any investment to economic growth and economic activities. The securitization has been supported, and Ian will talk of it more widely, by the market-led initiative, the prime collateralized security, that is an initiative to facilitate the possibility for investors to have confidence in the instrument, and as Miguel mentioned, the ECB has facilitated also the use of this instrument for the Eurosystem operations, and for the time being, in fact, has become the major demand of securitization. The investors base is composed by different actors. So traditionally, banks and insurance companies, but also retail investors or funds could clearly be related investors for this. So securitization shall be and is acknowledged to be by the policymaker and the European Central Bank as an essential instrument, essential tool to originate new lending. And the origination of new lending is in fact what the financial crisis has mostly created, the impossibility to generate lending, and this has led to the recession we are experiencing. Now, in this context, following the economic crisis, there has been the widely consensus that regulation somehow was insufficient, and it was important to tighten more regulation. We have seen that in all different angles, Basel III, CRD4, Solvency II, and in the near future there will be something on pension fund as well. But in all different angles of regulation, we have seen increased capital charges. And these increased capital charges, in fact, have made securitization much more expensive for investors. And this is the real question. The regulation shall prevent misbehaviors, and we have seen largely misbehaviors during the financial crisis and subprime crisis, but this is not related to the instrument as such. The instrument is an instrument. The misbehaviors have been behaviors using instruments by behaviors. Regulation should not kill the instrument or throw the baby out of the window with the bath water, but it would have to facilitate the achievement of objectives that the policymakers are setting, i.e., in our case, growth. Thank you very much.
Okay, thank you, Guido, for this overview of the side of the EIB. You already referred to the next speaker, prime securitized lending. So Ian came to explain it was a few weeks ago. I understood a bit of it, but so I'm looking forward to what you will be saying, let's say, just to really understand what you're doing with the prime securitized lending, of which also the EIB as a member, you have signed up to this. Ian.
That's right. Thank you very much, Carol. And thank you very much for coming here to speak. Prime collateralized securities, shortened to PCS, is an initiative that was set up with various industry players and the participation of the public sector. It's a not-for-profit independent initiative, so it's not a trade association. It doesn't speak on behalf of any group in the markets. They're on the investor side, on the banking or financial side. It doesn't speak for any institution or any public body. It really just speaks for itself. And its mission is to assist to bring securitization back to Europe as a strong, robust, safe financing tool for the benefit of the real economy. I think one of the things we can all agree upon is that the pre-2007 securitization contained a lot of elements that were not robust, not safe, and certainly did not in any way help the real economy. And so when we are talking about getting securitization back, we're not talking about getting the pre-2007 securitization back. We're talking about, not so much a new securitization, but actually making the distinction between what worked and what didn't work. And I will talk about this imminently. I do not have any slides because most of what I will say has been put into a white paper that we published yesterday. I encourage you all to read it. I think there are a few copies at the door, and if once those copies are gone, you can find it on our website at pcsmarket.org. So as I said, we have the mission to try to help bring back securitization in Europe. We're very open about that. We do it in two ways. We do it by an advocacy function, trying to talk and be an interlocutor who has something to contribute to the debate. And we do it also by granting a label, which we grant to what we consider to be high quality securitization. And again, if you go to the website, it's got a lot more detail about how you get the label. But now if I can, I will go through effectively the basic proposition, which explains why PCS was set up and why we think it's really important. We've looked also at the numbers, and we come to different numbers from the Commission, but basically we see that in the next 4 to 5 years, bank deleveraging will take out of the European banking system about 2 trillion euros. Those numbers are effectively, these numbers, by the way, are very conservative. We tried very deliberately not to bring the most scary numbers we could, but to actually try have a genuine attempt at figuring out the real amount of money that's missing. So the IMF numbers, as well as the bank's own numbers, suggest 2 trillion euros of bank balance sheets is going to shrink in the next 5 years. And the banks themselves, by the way, think this shrinking is going to take a very long time. 5 years or more is the view of almost 3/4 of the banks that were spoken to in a recent survey. So over 5 years or more, we're going to see 2 trillion euros disappear from the banking system. I personally think that's incredibly optimistic. I think it'll be more, but let's just keep with the 2 trillion. In addition, new regulations, and by the way, when the banks are asked why is this money going to disappear, over 3/4 of them cite as the primary reason for the deleveraging going forward the new capital requirements. Now, we don't at PCS have any issues with new capital requirements. We think clearly banks do need better capitalization. That's not an issue, but we just need to understand the consequences of that capitalization. The next item on the list is the liquidity cover ratios. This is a new concept introduced in the regulations. Again, we think it's a very sensible concept. Liquidity cover ratios make a lot of sense. Banks are supposed to have high quality, highly liquid assets set aside to cover 1 month's worth of outflows, so that we do not have liquidity crisis, or at least reduce the risk of those. However, looking at the way in which liquid assets are or defined in the Basel proposals, and the EBA is now conducting a consultation about this, we reckon that about 600 billion euros of additional funding is going to be frozen in those liquidity cover ratios. So that's another 600 billion gone. And then we have estimates of the need for growth to be funded in the next 5 years at coming in about 1.6, 1.9 trillion euros of additional money. So if you take the 2.6 trillion that's going to come out of the system, the 1.6, 1.9 that needs to come into the system in order to fund growth, we've got at least 4 trillion, 4.5 trillion of money that needs to be financed, needs to be funded in the next 5 years, which the banks are not going to be providing. Now, what does that mean? Well, of course, one of the arguments is, well, the banks could provide it, all they need to do is raise more capital. Banks raise capital, then the deleveraging need not happen because it's been driven by the capital requirements and the LCRs. We think this is perfectly logical, but it's also incredibly optimistic. There are lots of reasons to believe that banks are going to find it very difficult to raise the kinds of capital that we're talking about. And by the way, the conservative figures of the EBA, we're talking about, these are 2011 figures, 225 billion in order to meet the requirements, the Basel capital requirements, another 115 billion of capital. This is tier one equity capital, this is shares, right? Another 115 billion of capital required to meet the leverage ratios, the new leverage ratios. We're starting to talk about close to 400 billion. The proposals were there to be implemented on securitization that were just put out by the Basel Committee would add another probably around 35 billion euros of additional capital to that 400 billion. We're talking about very large sums of equity. Now, all other things being equal, this would be a large chunk of change, as they say in America, to actually part with in order to buy bank shares. But you have to then put into, then you have to take into account a number of things. First of all, existing shareholders are going to be very, very unhappy at the idea that their banks are going to dilute their shareholding to that extent. For those who are not certain that's necessarily true, when UniCredit raised 7.5 billion euros a year ago, its share price dropped by 45%. So we can see that existing shareholders aren't too happy. Secondly, we have the problem of return on equity. Return on equity for the big successful banks was about 15, 20% prior to the crisis. On average, it was 13.6 globally in 2007. Return on equity now, well, and we're in the middle of a crisis, return on equity right now in Europe is 0. Even for the banks that are doing well, returns on equity are about 5%. There is no way that return on equity is going to go back to what it was before the crisis, and that is a good thing. We think at PCS that we do not want returns on equity to go back to where they were, because those are the returns on equity you get for taking incredibly large amounts of risks. However, because we don't know where returns on equity, we don't, and nobody in this room does, the banks don't, none of the equity investors know where the returns on equity will end up after the crisis, after the regulatory schemes are put into place, when the banks become what they're going to become in the next few years, and we don't know what that's going to be. Nobody knows what those returns on equity are going to be, which means selling equity at this point in time in banks is incredibly difficult, because you're basically asking investors to buy a totally unknown quantity. That's difficult. So the dilutive effects, return on equity, there's also still large systemic concerns about banks. There's a lot of suspicion that banks still have problems. There's a crisis going on. There are sovereign issues going on. Again, raising bank equity right now is incredibly difficult. People will say, I'll wait until after the crisis is over, when things are stabilized, then I'll start thinking about buying bank equity. For all of these reasons, we think that the idea that banks will simply raise the 400 plus billion of tier one capital in order to avoid deleveraging is fanciful. So if the banks can't step in, will not step in, or telling everybody they're not going to step into this particular 4 trillion gap, the question then becomes, who else? Well, governments could step in a perfect world, but right now, I don't see the European governments putting their hand up for 4 trillion fiscal reflation. This is really not the flavor of the day. I don't think it would be sensible, considering the situation most governments find themselves in, and the tune, I think, for the next few years will be fiscal consolidation. I think that makes sense. So that means that the money is going to have to come from the only other player out there who can actually provide this financing, which is the capital markets. So we're going to need to get an extra 4 trillion euros at least, if not more, from the capital markets in the next 5 years if we do not want to have a period of stagnation in Europe that is going to be parallel to that, which has been experienced by Japan. Capital markets do have the money. The cash is there, that's not an issue, and plus they're global capital markets, so even outside of Europe there are very large pools of money that are capable of funding a 4 trillion euro gap, in fact very easily capable of funding a 4 trillion euro gap. However, we would very much caution against what I've described as the Barnum approach to the capital markets. And I don't know if you know, there's a quote attributed to Barnum, the showman in America, which is, build it and they will come. And there is a little bit of a tendency sometimes to think, well, we've got a 4 trillion gap. There's a capital market out there, so just look at the gap and the capital markets will just come and fill it. They will. It's a natural process. Nature abhors a vacuum, and they will just come and fill it, so we don't have to worry too much about it. We think, and again, our white paper tries to analyze this, large corporations will be able to access the capital markets by issuing corporate bonds. That's relatively straightforward, and we actually do think that part of the story is about as straightforward as it gets. Interestingly enough, the highest ever issuance of investment-grade corporate bonds in Europe was in 2009. The second highest ever was in 2012. No surprise there. So large corporations are going to be able to go to the capital markets, will go to the capital markets, have gone to the capital markets. But then where does that leave SMEs, mid-caps, which is a topic of discussion, and to some extent also consumers? Try getting a mortgage nowadays in Spain, try getting a mortgage nowadays in the United Kingdom. It's not entirely straightforward. But let's talk about SMEs and mid-caps. SMEs and mid-caps do not have any obvious direct access to the capital markets. There are lots of things which are being discussed. Insurance companies buying whole pools of SMEs, bundling pools of SMEs into some instrument that can be sold to retail. All of these things are actually quite interesting. All of these things are worth investigating. But we would caution that all of these proposals have a number of hurdles. They are not straightforward propositions, and this is where I go back to my Barnum metaphor. It is not simply a question of saying SMEs have a need, capital markets have money, there we're done, can we go away now? Capital market investors, by and large, and retail investors even more so, are fundamentally risk averse. This risk aversion is not simply the fact that they do not like to take risks. It is a very deeply embedded culture. If you are in a bank, you lend to a book of credit card borrowers, you lend to a book of SMEs, you know you are going to lose some money. It's unavoidable, you will lose some of your principal. The idea is that you charge enough interest on the people who will pay so that your book as a whole makes a profit. But so when you're underwriting risk, you underwrite it with a base case scenario idea of loss. This is not how most capital market people perform. This is not how they approach investments. Some do. You've got venture capital funds that very much do that kind of thing, but the big players don't do that. So you're going to need a very big cultural change in order to get large amounts of the capital markets to be willing to invest in SMEs and in mid-caps. In addition, you're going to need structures. These people are going to need to hire people. They're going to need to basically bring forward new business models. If you're going to lend to granular pools, SMEs, you're going to lend to granular pools, mid-caps, you're going to lend to granular pools, mortgages, you also need people, you need structures, you need computers, you need people who are going to kind of send application forms out. You're going to need to kind of treat those application forms. You're going to need to process them. When people don't pay, you're going to need to chase these people. All this is not straightforward. This takes time, this takes money. So you've got a cultural change as to risk, you've got an actual infrastructure that you have to build. Also, you have issues of liquidity. Capital markets investors like to have liquid bonds that they can sell if they change their mind or if they want to reprofile their portfolio. There is, at present, no liquid market for individual or even pooled SMEs, individual pooled mid-caps, individual pooled mortgages. You cannot just sell these things. So again, liquidity is a huge issue. And global players, you cannot lend to SMEs, you cannot lend to mid-market, mid-caps unless you understand the market. You understand Spain, you understand Portugal, you understand Denmark, you understand those areas, you understand woodworking, you understand high optics. You need to have the kind of credit knowledge that makes that lending possible. Very difficult to mobilize non-European lenders, non-European capital market players into lending directly or near directly to SMEs and mid-caps. The amount of knowledge you need requires you to, again, hire people, have infrastructures that don't make sense unless you're willing to lend tens of billions of euros. So all of these hurdles have to be taken into account when people look at, will the capital market simply fill in the gap? And this is where we believe that securitization does actually work. because securitization is credit tranche, you can create, as Guido was saying, high quality tranches. It appeals to the culture of low risk, no risk, low risk. Because the loans are generated by financial institutions, it means that you do not have to create and pay for this entire infrastructure that you would need to do so as a capital market investor. You can actually let people who've already paid for that infrastructure, namely the banks, make that lending, make the underwriting, make the collections, and you can get the benefit of the credit without having to pay for the infrastructure. Securitization bonds are liquid, they can be traded, which means that you can feel comfortable that you can actually go to the market and get rid of your position if you want to reprofile your portfolio. And because they are bonds, they are much more attractive to global investors who can actually compare them to other bonds with similar profiles. So securitization, we think, is not the solution to the 4 trillion. It's not even necessarily going to be the biggest part of the solution, but it is the only tested, scalable, available tool which can start right now, right here, to start filling this gap. Now that's the plus. We also are realistic. Securitization has a bad reputation for fairly good reasons. And so any kind of attempt to bring securitization back also needs to deal with the past. And we need to be very honest about what didn't work. Ultimately, we know our views do not depart from those of the Commission, and we've structured it differently, but we think that there are 4 things, if you look at every securitization that has failed anywhere in the world for other reasons than fraud, there are 4 things which have gone wrong. One of 4 things, not necessarily connected. 1, originate to distribute. Originate to distribute when banks no longer are interested in the long-term health of their lending because they're only going to have it on their books for 4 to 6 weeks, creates catastrophic declines in underwriting. Can be dealt with. There are rules such as the skin in the game rules, the 122A here in Europe. There are ways in which to prevent that, but anything which is originate to distribute, you have to worry about that. 2, leverage. Any kind of securitization where very small changes in the credit performance of underlying collateral generated very big impacts on the performance of the securitization. So skin in the game, originate to distribute, we're looking at US subprime. That's the catastrophe US subprime. Leverage, small changes in underlying collateral impacting the securitization at the high level. That's CDOs, CDOs of ABS, CDO squares, CDO cubes, CPDOs, CPPIs, and there are lots more of those. Those were all built on the idea that you can actually pool a lot of very, very risky stuff and you could model your way out of the risk. And we all now know that this is just nonsense. Maturity transformation. All securitizations where you couldn't pay off the whole securitization with the underlying cash flow, and that at some point during the securitization you're going to need to refinance yourself in the capital markets. So that not maturity transformation by itself. If you pool mortgages, that's maturity transformation. But if you have the maturity transformation embedded in the securitization, you're relying on a capital market takeout. It doesn't happen because the markets are disturbed. You go down. This is what happened to a lot of the CMBS transactions, and this is what happened to structured investment vehicles. The final 4th thing that went very badly wrong with securitization pre-2007 is transparency, as was mentioned by the Commission. Lack of transparency, you don't have the data, or even worse, lack of transparency because you have all the data, but your deal is so complicated that there's absolutely nothing you can do with this data. You have 15 million data points just staring at you, and you still have no idea what you're going to do with that. So complexity, lack of transparency because of complexity, lack of transparency because of simply no data. Those are also things that went very badly wrong with securitization. We think we have to be honest about that. We need to build a securitization market that doesn't have any of those 4 things. But then when we look at regulation, we need to calibrate that securitization market based on how securitizations which didn't have these problems performed. And this is where we've seen the information. They actually perform very well. So that's our basic proposition. You need securitization because it's the only scalable, tested, available technology you've got right now to bring capital market investments to SMEs and mid-caps. But you have to do it in a sensible way which actually learns from the lessons of the crisis.
Okay. Expecting you were going to say something specifically on what the Secretariat does about this, the PCS.
Well, we actually have a label. We give a label to securitization that does incorporate those lessons of the crisis. So it goes for simplicity, it goes for transparency, it goes for also things that fund the real economy. So no synthetics, no re-securitizations.
But you're somewhat a self-regulatory organization, if I understand it.
We are, yes, I mean, issuers have to come to us. We're independent, not-for-profit. Not-for-profit is important because, of course, we did see what happens when you're a for-profit self-regulatory organization. I used to work for one. So we're not-for-profit, but yes, it is. It is not really self-regulatory in the sense we're not owned by the banks. We are kind of independent, and we are, although we've got some seed money for the next couple of years, we will be self-funding after that.
But how do you enforce your standards? Meaning, if you have certain standards, if you, for example, towards the EIB say, "Whoa, what you have done, this securitization, we don't agree."
Basically, you have to get the label. You bring your documents to the Secretariat. We test against the criteria. You either meet all the criteria or you don't. The criteria we have seek to be incredibly binary, black or white, rather than full of subjectivity. So we don't have criteria which have the words, you know, reasonably or in great part, substantially, to all material extent, because then we think that's one of the problems that the agencies had is the classic problem of boiling the frog, which is, you know, you throw a frog in hot water, it jumps out, but if you put it in cold water and just raise the temperature little by little by little over time, it will just die in the hot water. So once you have criteria that say, oh, reasonably, it's like reasonably is 99%, and then it becomes 97, and then it's 60, and then one day you're asking yourself, how did we end up at 5?
Okay, thank you, Ian. So that was about securitization. You know how three different players in the market, say the Commission, the EIB, and then the PCS Secretariat. We have time for questions. Who wants to stand up? Let's say, kick off the debate. I raised my questions already, so I could ask many more to PCS. Mirza, and yes.
We see in the new regulations that this is, and Fitch also commented, this huge discrepancy between the new capital requirements and the effective performance of the securities as shown as well. Is this something that will be addressed in the future?
Could you inform us who you are?
I'm working for Belgia's Bank, structuring securitization.
So what precisely was your question at the end?
That I receive the new capital requirements, like proposal for securitizations in the Basel III, and there we see that the capital requirements are very high compared to the actual performance and the loss figures as shown as well. And we see that the actual performance of AAA European ABS or MBS is like extremely high, and then still we're faced with, compared to that, very huge capital requirements imposed by the regulators.
So that would be your main reason why you think this market is dead and will continue to be dead for the time being, as long as it is
Yes, because if
like
you
this.
have that discrepancy between the two, you're always going to pay a cost which is too high, because if banks grant loans, they look at the actual performance of the underlying assets, which are taken into account when charging the interest rate on the loan. But if you then need to, on the other hand, very high cost for securitizing, then there is an imbalance between the two. Unless, of course, the interest rate on loans would rise significantly. I don't think that's the purpose neither. So my question to
Ian or Guido? That's, or Miguel?
Two short comments. I mean, one is very practical. I think in the near future, we still have not yet adopted CRD4. It's a matter of weeks, maximum months, I would hope. Now we're really close, finally, as probably many of you know. So we're implementing Basel III to a large extent through CRD4. I don't think it's going to be easy to change that anytime soon. Certainly not in the timeline that we're looking at now in terms of reviving the securitization markets. Now, having said that, I don't want to open that debate, but I would take a little bit issue with the argument that imposing capital charges in and of itself, it's necessarily going to deter from investing in products that are performing well. I think that there's a big issue there as to whether or not, and that's related to the point made earlier. I mean, whether we should expect banks in the future to continue to have the same returns on equity they observed prior to the crisis. I think the answer to that is obviously no. And then as soon as these banks become safer and capital requirements are intended to do that, I think there's going to be a rebalancing of the activities, and in part some of that rebalancing should turn towards products that, if they do perform well, and they are, in my opinion, they also need to be standardized, which is complement to what PCS is doing. They have to be transparent, etc. I mean, in the long run, I think there is still quite some hope for the markets to revive. But yeah, I don't want to get more into the issue of the capital requirements.
I will make an observation and a comment. The observation is capital requirements apply to Basel III in particular applies to banks. So sometimes the universe is restricted to banks, and I think if we look at it from a different angle, what the regulation is trying to do, and I'm not judging whether it's good or bad, it's just observing. The regulation is trying to reduce the risk appetite of banks, and it's succeeding in doing this. So we have seen the leveraging, but in fact, following the financial crisis, banks demonstrated that had gone too far, and the regulators are overshooting probably in make them less risk or more risk adverse than they were in the past. Now the fundamental question is, if this was the aim, and we can think that maybe it was a legitimate aim, the point is, who else? So if banks are not addressed to be the investors for this kind of product, then who else? Now, I mentioned in my short presentation that the regulation has limited the potentiality of other investors, so insurance companies with Solvency II somehow not incentivized, to say the least. And now, as far as I understood, there is going to be also for pension funds certain limitation to that extent. So the question is more, what do we want to achieve? So if the idea was to reduce the risk appetite of institutional investors, this is accomplished. Now, if we want then to foster economic growth, then we have to understand which other players can play that role. And there might be advantages in doing this, because in the past, one of the problems the securitization had was that it was a recycling tool. So somehow banks were issuing a securitization tranches, and then these tranches were sold to banks. So at the end, they stayed in the banking system. So if they, from an economic point of view, the approach of securitization as distribution risk is to ensure that the risk which is generated in the banking system is distributed to the economic world outside of the banking system, then the regulation is achieving its goal. What is missing is the next step. And what, for example, I observe is that the retail market, for example, is not available at this stage for these products. And Miguel mentioned that in the European, not the US, but in the European world, in fact, these products are very safe. Surely more safer than Greece and other products that are considered very safe in the first place. So at the end, why not? Why not, for example, enlarging the investor base to include, for, of course, the senior tranches, the ones that might be having a PCS label, that have recognized to be simple, standard, and so forth. The possibility to invest in this product is a long-term investment. they are not particularly liquid, so are not available for trading on a daily basis. It's not their nature. So why not extending it to some others? And then banks would be happy anyhow because they can originate and sell.
Ian, very quick response to is
Yeah,
capital charge too high?
I agree with Guido, but I think we also need to be careful about the issue of capital charges for banks, because Guido's quite right. I mean, if the idea is to get the capital markets to replace the banks because deleveraging, then it shouldn't matter so much that the banks cannot be the main holders of this. However, this is where the unintended consequences of the interaction of various regulations start to play. Because one of the other parts, of course, of the regulation that Basel's trying to introduce is the equalization of the trading book and the banking book, which means that if you're a capital market player and you want liquidity, and your banks are telling you they will not buy this paper, even on the trading book, to resell it, then you've taken a huge chunk of liquidity out of the market. That makes it a lot less attractive for, say, an insurance or pension fund to hold this paper. So there are knock-on consequences about very high charges, especially if they also apply the trading book.
Bursak, and then there, yes, 2 questions. Yeah, Bursak.
Sure. I think that securitization, because of credit tranching, is actually quite indifferent to those issues. And the reason for this is because you have issues. For example, if you're just talking about a local player who plays in a very small geographic region, you've got concentration risk, obviously, if all your SMEs are from the same small region of the same country. But that can be taken into account with greater subordinated tranches. So you create a smaller senior tranche. The technology can basically work for all groups. There's no doubt that the wider the pool, the more diversified the pool, the more the correlation issues are smaller and the easier it is. But you know, the technology can adapt itself to either. Capital markets like liquidity. So if you're going to do a securitization of less than a few $100 million, it's going to have to appeal to a very small group of investors. The big capital market investors, and this is not because it's more or less risky, it's just that very small bonds tend not to trade. It's very difficult to sell, and therefore they're less attractive to the capital markets.
For a single issuance, say, of a securitization product.
I'd like to make a comment, I think, on your question, because I think it's, I mean, the answer you've given is perfectly fine. I have no issue with that, and I think that is a matter of theory, but also practical implementation of securitization must be right. But I think it's not the only issue, right? It's not just a matter of being able to diversify, and if you diversify less, you have more correlation in terms of the risks, then effectively you just have a bigger subordinated tranche. That's, and they also is a question of, I think that's more or less that's how I understood your question initially, is more how do you acquire good information about, you know, the actual prospects of particular SMEs, investment opportunities, and is this a question of uncertainty and really lack of knowledge about the underlying performance of the underlying pool that creates distrust, and it's not really so much a matter of how you diversify enough. And I think that is an issue where this question of the business model needs to be resolved, I think.
May I make a comment on this? It's a very valid issue in the sense that I mean, EIB Group is financing SMEs. The SMEs is the core of the European economy. It generates 1 job out of 3. So of course there is a fundamental question how the SMEs can be financed at best if the deleveraging of banks prevent bank from extending lending to SMEs. Of course, SMEs have a problem. The business model which is missing somehow is how you can get to the very small SME and make sure that the small SME gets into a, say, platform or in a different setup such that it can reach a capital market size. The capital market size requires a volume, requires standardization, and requires diversification. Now, these things are somehow complex in Europe because we are not standardized, we are not homogeneous, we have different regional reality. So the difficulty, and I think this is why Europe has not done it yet, even there had been in the past discussions and there were even some sort of attempts to do multi-originator transactions exactly for that purpose, is how to combine efforts from banks. I think banks cannot be avoided in terms of being ultimately the only entities which can go to the level of SMEs across the whole Europe. So you need a risk assessment, and this has to be done, I can't see, by anybody else than banks. But then how you regroup. So how then, when you have done your credit assessment, you have the loan by loan data required by ECB. So you have the information. The information is gathered in order to regroup all these loans originated across different banks and different regions, and then assemble together in order to make them available to the wider public. That would make the difference to SMEs.
We have about 3 questions, yes? I mean, yeah, quickly, and...
Initiative you see in France where there is an initiative to gather SME lending and to have one issuer of securitization. It's just one country in Europe, and it can be quite regional.
Yes, in fact, there are some attempts in different periods during the history of securitization. You have seen this. So if you might remember, KfW was with a promise was trying to facilitate also this. It was a synthetic approach. So there have been different attempts. However, what is missing is a European based approach, and the single countries, I don't think will reach the size that is needed to make it absolutely effective. And this is what is the next step. Whether it comes or not, we will see. But
I had 3 other questions. There was Madam there. Yes, if you identify yourself, and yes. Okay, can I take the 2 other questions first? Yes, the 2 others. So the question on contagion and no need for capital market.
My name is Jeroen Bavema from Prudential. We are a full boutique trying to help investors and banks with their communication about credit risk and very active in financing in mezzanine and equity tranches in SME securitizations, and they still want to be in this market, but their complaint is there is no supply by banks. And I think one of the reasons is, and you have not addressed it in your presentation, and I'm very interested in your ideas, is maybe has to do with the fact that banks, if they price loans in the primary market, they do it in function of their Basel II parameters, that their PDs and their LGDs, and they put that in their so-called railroad models. Whereas investors, if they want to buy, and in fact the tranche is a derivative from this pool of loans, they have to price it in function of a market price. And the market price is driven by traders who are looking for relative value, but they are not interested in the hold-to-maturity value of an asset. And so I think IFRS is also causing a problem, a sort of pricing gap between banks and investors. Is this something you also have on your radar screen, or do you disagree, or are there already certain solutions underway?
Okay, thank you. And
Patrice Müller from London Economics. The question I have is whether securitization is really good for or useful for all SMEs, right? Because the SME population is very heterogeneous. We have very large chunk with no employees, self-traders, and they are not investing for project finance type, but they even have needs for cash flow management purposes. Same thing for the small SMEs from 1 to 9, which have very different needs from the M's, the Mittelstand in Germany. I was wondering whether what we're talking today is more towards the M size rather than the S and micro and very small, and they are the bulk of the SMEs in the population.
okay, thank you. Shall we start with Miguel first, or?
Well, I have really very little to say to these comments that have been said, other than maybe on the last point. That, I mean, most SMEs that are of the range of 1 to 1 to 9, yes, indeed, I think in the initial stages of the development, they probably need finance for cash flow purposes. But I mean, we ought not to forget that the mid-caps were also SMEs one day. And in some sense, I think it is important to give prospects to all SMEs, including the very small ones, that if at that point at which they want to make that significant step forward, they'll have a possibility to access capital markets through securitization. So I take your point, but I think there's still room for extending some of these instruments for the very smallest of SMEs out there.
And on the question on IFRS, or on the...
And the question on IFRS, I have very little to say, because although I agree with your analysis as you presented it, I have never personally thought about this very much. I think it's rather a question. It's one of those things about coming to events like this that you always leave with some question yourself. So I'm going to take it back, and I hope on the next occasion, if there is one, I'll have an answer to it. I don't have one now.
I'm not to answer all three questions. On the type of SMEs involved, again, securitization is indifferent. I mean, one of the biggest markets in securitization in the United States is credit cards. So you can't get smaller, more granular, and shorter term than credit cards. So all the securitization does is it provides a way to convey capital markets money into lending, irrespective of the type of lending. And obviously, some lending is easier than others, but actually, in this respect, the smaller the SMEs, the more the lending is better accessible. So in that sense, it's on the pricing thing. Pricing for SMEs is actually a complex issue. There are a number of issues that make it difficult to securitize SME lending because of price differential. One of them, of course, is that the loan to SME is only part of the relationship that a bank would be a fine, for us, that would be a fine outcome. What we are very concerned about is the next 5 to 10 years. And we just don't see that happening in the next 5 to 10 years.
Guido, and then
on the contagion, I think we have a dilemma. We have seen the capital market is wild, the animal spirits, say, that somebody mentioned in the past, so well known. We know also that the buy and hold approach is somehow dead and is not coming back again. So you will not have long-term investors who are going to hold assets for long. And whether good or not, the reality is the regulation is somehow making it very expensive. So whether it's a bank, is an insurance company, is a pension fund, all these actors are going to face the requirements of setting aside capital for this long-term investment. So somehow the dilemma is we can say the capital markets should be avoided, but then we do not have long-term investors at hand, apart from European Investment Bank and a few others. Or we keep away the long-term investors, and then we go only to the capital markets, but the capital markets is too volatile to facilitate stable absorption of this. I think that probably the truth would be in between. I mean, we need probably a well-distributed participation of all the different actors for different reasons. What is missing today, I think, is a helicopter view which would allow the possibility to give incentives or disincentives in a balanced way. This is really missing. And then we suffer, economically we all suffer, because then actors cannot really rationally behave because subject to constraints that are not fitted very well in the overall scheme. On the pricing, I think what is missing again is the fact that, yes, you're right, if when the loan is originated, a bank would have Basel III into mind. If you have a capital market, a trader, you would have a completely different approach in pricing. Now the question is, again, maybe the helicopter view, from a bank perspective, you are originating a loan. It should not be driven by your trader. It should not be driven by the guy on the counter who is giving the loan. It should be given by a much more elaborated view of what a bank economically wants to achieve. This is missing. This is missing because it's hard, because you have institutions that have become elephantiac. They are too big. So how can you grasp all the different impulses that you have at all different angles, being it a dealing room or being it a counter in a remote region across Europe? How can you gather all the information to provide a systematic approach in the origination business? This, I think, is what is missing, and then you have fragmented action or dynamics that you can see, and from a larger perspective, then you miss a bit the logic. And to reinforce this, I think the PCS was born because of this. I mean, PCS was born by initiative of EFR initially, the European Financial Financial Roundtable, and these were the CEOs of the large banks in Europe who understood that there was something missing. If they were listening to their capital markets people, then they understood that they were killing the product. They were missing, the incentives were not there. So it was important to step back and try to say, okay, listen, but in the next 3-5 years, what do we need? How can we make sure our business can continue? And on the SMEs, whether we are talking micro, small, or mid, I mean, Ian mentioned you have securitization of consumer credit cards or the like. So the size is not necessarily relevant. It's a question of investor base. Who is interested to buy these things? So you need to have a specialized investor base who would have the appropriate interest for the different underlying assets. It is true that investing in microfinance is definitely not the same as investing in mid-cap. So you need to ensure that you have investors who have understanding for both, and then yes, the instrument can be used for both.
Well, you still want to reply to the other question?
Well, I
about the
apologize
banks versus
'cause
capital markets?
I forgot about addressing that question. So two quick comments. The first one is capital markets can obviously be improved. Where they, in a way, sort of interacted, intertwined with very global banks and leading, in a large extent, to some of the key causes of the crisis. That's true. But when developing capital markets in Europe, we can do so in a way that these markets are safer. And there's essentially two ways to do that, two key ways. I mean, what we want to do is get demand together with supply. So what are investors interested in? They're interested in transparency, they're interested in simplicity. We need to ensure that we can find mechanisms so they understand what is the performance of the underlying pool of assets in which they're investing, and that they're clear about what's going to happen in case of default. Secondly, so this process should not become overly complex. And secondly, we need to find a way to standardize, offer standardization opportunities, because this is the best way to price these products, and this is the best way to ensure that secondary markets are going to develop, and that's going to bring investors, even the institutional investors. Now, if we do this, we have much safer capital markets, which are certainly worth developing, because the crisis, if we look at it, it's gorgeous. It is a banking crisis. It's a banking crisis, and in the US, it has become a lot easier, I think, for them to come out of the crisis, to rebound faster, because in part, you had not just large corporates, but also SMEs and mid-caps who could continue to have access to credit through resorting to capital markets. That hasn't been possible in Europe. By contrast, in Europe, we've had to have the sovereigns step in, and we all know what type of feedback loop this has created and where we are at the moment. So I think it is, when you look at the percentages, 20-80 in the US versus the reverse here, 80 banks, 20 capital markets, there is, and we look at this development of how we're rebounding from the crisis, there is clearly a role here for capital markets to be part of the solution and not part of the problem. So I hope that efforts like the ones taken at the level of the EIB or the Commission, or certainly private approaches, will combine work to ensure that we can revive securitization. It'll be really an important part of the solution, I think. I hope.
Well, there are still 3 questions I just wanted to finish, but so I would say very quickly, neighbor of Bursak, yes?